I think it's an interesting thought experiment, but my guess is the higher the price of metals go. I mean, look at gold. A tube of gold eagles now is well north of $80,000. You take the top of the cup with 1980, and silver's in a 45-year cup and handle. Everyone talks about that. And breaking through 50, you're breaking through the cup. You're breaking through that resistance level, the big cup, and then the handle. It's like a double cup and handle almost. But that, if you take the way you measure that in technical analysis, you take the top of the cup and the bottom of the cup. The top in 1980, the bottom in the early 90s, $4, $50. The difference, $46. You add it to the top when it breaks through, that puts it at $96. And I would say that silver will follow. To what degree remains to be seen, but $100 silver is not stupid.
Andy Schectman dives into the technical setup for silver, focusing on its long-term chart patterns and historical context. He highlights a 45-year cup and handle formation, noting that breaking through the $50 level represents a breakthrough in overcoming resistance, essentially completing a double cup and handle. Using classical technical analysis, he measures the potential upside by comparing the top of the original 1980 cup, calculating a possible target near $96. Schectman emphasizes that while exact timing and degree are uncertain, a move toward $100 silver is entirely plausible given current momentum, market dynamics, and historical precedent. This scenario illustrates how historical patterns can offer insight into the potential of precious metals in the future. If you found this analysis helpful, make sure to hit that like button. Share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
It will consolidate into more major dealers, or those smaller dealers would consolidate, in my opinion, because the cost of maintaining an inventory is becoming exponentially more expensive. And with that, you have insurance and shipping and all of the things involved. It's expensive. It's much more expensive than it was to hedge a position at higher levels. Takes away some of that risk, but most of the smaller coin companies or local coin shops don't hedge their exposure. So it's a big deal. You have a large inventory of silver, and the volatility that we've seen where it can fall 15-20% in a short period of time. That's enough to really scare a lot of these coin shops out of business. I think it's an interesting thought experiment, but my guess is the higher the price of metals go. I mean, look at gold. A tube of gold eagles now is well north of $80,000. And so how much gold can you really have as a local coin shop, not only from a standpoint of maintaining an inventory, you better have millions of dollars to use, but insurance and shipping and all of that stuff, it's becoming a lot harder. When gold was $1,000 an ounce, I remember my father-in-law sending me a text message, congratulations, so gold's finally over $1,000. Well, back then, it wasn't too long ago, a tube of gold eagles is just over 20,000. It's gone up 4 times, and that's just one tube. So you want to have 500 ounces of gold in stock as a local coin shop? I mean, how much money do you have? And then you add silver and platinum and the cost of insurance and whatnot. It's a tough deal, I think. The higher it goes, the fewer the choices, if I had to guess, you'll find. So again, this further would, I think, push towards consolidation into the larger companies who have the wherewithal to do it. That's not great for the consumer, but it's just the reality of the cost of doing business. And it's increasing dramatically. If it continues down this path, it would be very interesting if you saw triple-digit silver where, you're talking $50,000 for a monster box. Yeah, it's getting tough, but triple-digit silver really isn't that crazy anymore. Keith Neumeyer was the first one to talk about it, and when you look at the fundamentals behind it, it's not that outlandish to say that. In 2026, revaluing gold. Now the question is, do they revalue it to market, or do they revalue it to a number like James Rickards says of 24,000? That's debatable. We'll leave that up to the future to decide, but there's a 95% correlation in all of history between gold and silver. They don't move independently of one another. They move in tandem, not always in perfect symmetry. That's why they say gold goes first and silver goes further. My guess is that you're not going to see gold go to the moon without silver following along closely. And on a percentage basis, much, much more. What also I think highlights that is the amount of deliveries into this country. And, everyone was saying and they still say it, that it's tariffs. And I just want to say BS, it's tariffs. It's not tariffs, everybody. That's what they want you to think. That was what enabled the free flow to come into the country. Yes, tariffs, you'll get it back at some point, but for now we need it because it's tariffs, because we have these huge short positions. And if we have to pay the tariff to cover our shorts with all the delivery requests, we're dead. So send it back, not tariffs. They're reshoring it. And they did this before, oh, by the way, we're going to reclassify it strategic. You think that silver's flowing back? No, some of it flowed back. Sure, some of it was tariffs, some of it was arbitrage, and some flowed back to give the LBMA another couple of weeks on their lease on life. They don't want it to blow up so fast, but 50 million ounces goes back there between Shanghai and COMEX. What does that give them? Another few weeks, a month? It was already trading in backwardation on Friday. It's right there. It's hanging on by a thread where there's 700 or 800 million ounces traded every day with 150 million ounce float, meaning there's 150 million ounces in silver bars that we're told. Who knows if it's all available, but they're trading 800 million ounces in deliverable spot contracts every day. I'm having David Jensen on Wednesday, who is an expert on the LBMA, and everyone should check out his Substack. He's fantastic. I read him everything he puts out. This is exactly what he's been saying. This is what I've been saying to you since 2020, that there is a rush, which starts out slowly and quietly, to accumulate. It started with the others in 2020, the big group that came on the Commitment of Traders report. Who are they? They're sovereign wealth funds. Who are they? They're central banks wearing a different hat. They're their friends. They're their associates. They're the biggest money in the world, but the most well-informed money in the world. And then it's the central banks. It's the commercial banks. Now we get validation from China and from the United States that it's really important to hold this stuff. And we can see this. We see the exchanges breaking down. If you don't, you're not paying attention. So yes, this is changing very fast. And I think that you can only manipulate a market over a period of time by pushing in the direction that it is going. And it was easy to hold down gold and silver for all these years in a world where the dollar was revered and our policies and our currency and our institutions were trusted. Are any of those things true anymore? Maybe not. And if so, you're seeing a slow motion rush. Not too fast to cut off the nose despite the face. Everyone said, why don't they just drain the LBMA? Because it would be over like that. Instead, you bleed it by a million paper cuts. And at some point, that becomes, the patient starts bleeding out from all the paper cuts, then everyone rushes. How far we are from that, I don't know. But I would say that to be on the wrong side of this trade right now, when you see the resiliency, the strength, where it's right back up over $50 again after everyone's saying it'll be another 10 years before it gets back. It's over, they said, when gold broke through 4,000 down to 3,900. It's over. No, it's not. When you have the chief investment officer of Morgan Stanley saying put 20% of your assets in gold, and when I say gold, I mean silver too. He didn't say that, but I'm saying it. When you see Michael Hartnett saying no, 25%, when you see Jeffrey Gundlach saying 25%, the Bond King saying 25% isn't overweight. You see all these things happening at the highest level, talking to institutional traders. No, we're not. And silver will outpace people's expectations, and gold probably will get revalued. I do believe it will. And silver will come along for the ride. To what degree? Don't know. But even if silver was gold was marked to market on the balance sheet at $4,100, well, let's take 4,100 and divide it by $42. That's pretty easy math-wise. It should be right around $100. But 4,100 divided by 42 is $98. 42 is pretty much the average gold silver ratio of the past 100 years. So silver could easily double. And it's funny if you look at the way cup and handle formations are measured. You take the top of the cup with 1980, and silver's in a 45-year cup and handle. Everyone talks about that. And breaking through 50, you're breaking through the cup. You're breaking through that resistance level, the big cup, and then the handle. It's like a double cup and handle almost, but that, if you take the way you measure that in technical analysis, you take the top of the cup and the bottom of the cup. The top in 1980, the bottom in the early 90s, $4, $50. The difference, $46. You add it to the top when it breaks through, that puts it at $96. That's 42 to 1 right now, which has been roughly the 200-year average since the Industrial Revolution. So Keith Neumeyer wasn't wrong. He's just early. And I would say that silver will follow. To what degree remains to be seen, but $100 silver is not stupid. It is not out of line. And if you realize it's really coming out of the ground at 7 to 1, that's the geologic ratio. He said it again today in an interview I listened to. I was listening to an interview him today, and you take 4,000 right now and divide it by 7. Silver should be $570 right now, based upon the geologic ratio. So these numbers that seem absurd really aren't from a logical perspective.
The rising costs and logistical challenges of maintaining physical precious metals inventories are driving consolidation among larger dealers as smaller coin shops struggle to manage insurance, shipping, and price volatility. As gold and silver prices climb, the financial and operational burden on smaller players grows, favoring well-capitalized firms. Historical trends indicate that gold and silver tend to move in tandem, with silver often outperforming gold on a percentage basis. Current market dynamics, including strong institutional interest and central bank involvement, suggest a continued upward trajectory. Technical patterns, such as the 45-year silver cup and handle, support targets near $100 per ounce, which is consistent with historical gold-silver ratios and geological considerations. Silver is poised to follow gold's lead, potentially doubling as markets reprice metals and adjust to growing demand. Let's get into the interview.
Well, I think it means a lot for the LBMA. Because of this, and because the move to classify silver as a resource of national interest, that's China. And then you add the U.S. putting it on the critical mineral list, which means they too can curtail exports. The president can do it without congressional order. And then you look at the essential role of silver in solar panels, electric vehicles, semiconductors, defense, you name it. I think what it really does is it shows that both countries are viewing silver as a strategic asset. It's not a commodity anymore. And, I think you're looking at a potential supply crisis and rising strategic value. What starts out as a trickle turns into much more than that. And, the people watching this show and listening to others in the industry who talk about this are way ahead of the curve and think, well, geez, everyone knows this. But walk outside your bubble and talk to anyone who's well-read, reading the wrong stuff, mind you, they won't have any idea about any of this. And so we're a ways away from that moment where it turns into a stampede. But it will curtail, I believe, it will curtail supply. And in a market like silver that is so massively rehypothecated at the upper levels, meaning the same contract is sold over and over and over and over again, creating a real problem. Remember, the market cap of silver is the size of a pinhead, and you throw a bunch of money at it, and it doesn't just go up, it explodes higher. This is what they've been trying to hold back. And I think that the big money across the globe understands this. I think they understand that this is a rush to a quiet rush to accumulate the resources. And I think they know that that if they don't do this, they being all of the governments, and really work hard at protecting their own supply chains and their own strategic stockpiles, silver is a necessary element. It's necessary in moving energy. It's necessary in moving civilizations. As dramatic as that sounds, there is no element on the planet that conducts heat and electricity better than silver. People say copper. Copper's too slow. Copper's going up too. It's reclassified. But silver is a needed element. It is critical. And I think it will start to affect the supply chain. I think people take for granted for far too long how easy it is to get silver. I talk to people all around the world who have a next to impossible time of getting it all around the world. I get emails every day saying it's impossible to find silver. So it's been something we've taken for granted here in the U.S. I could see that rapidly changing if all of the governments start to say, hey, we better get into a protectionism type of mode and not sell this to the United States.
The classification of silver as a strategic resource by both China and the United States marks a significant turning point in the global market. No longer just a commodity, silver's critical role in technology, renewable energy, and defense is reshaping its international value. Supply chains are tightening, and rehypothecation at the upper levels exacerbates scarcity, creating an environment where even modest demand can trigger sharp price movements. Those paying attention now are far ahead of the curve, recognizing the quiet accumulation by governments and major institutions. With strategic stockpiles prioritized and protective policies potentially limiting exports, the market could face a real supply crunch. Silver's unique properties make it indispensable for modern infrastructure, and scarcity will increasingly dictate price behavior. For investors positioning themselves for this shift, awareness and patience will be key. If this gave you value, smash that like button, share it. with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.